Welcome back to the Daily Economy 24/7, where we break down the numbers that move the world. I'm your host, and today we're diving deep into the unemployment rate, now sitting at 4.6%, the highest in 4 years. But this episode isn't just about the number. It's about the story behind it, the sectors slowing down, the households feeling the squeeze, the policymakers walking a tightrope, and the scenarios that could shape the economy in 2026 and beyond. Settle in, this is a full deep dive. The headline number, what 4.6% really means. Let's start with the headline, unemployment at 4.6%. On paper, that number doesn't scream crisis. Historically, many economists consider anything under 5% to be relatively stable. But in economics, numbers don't live in isolation. Trends matter more than snapshots. If we rewind just a couple of years, unemployment was hovering in the low 3% range. That was one of the tightest labor markets in modern history. Employers were competing for workers. Signing bonuses were common, wage growth was strong, and job seekers had real leverage. Fast forward to today, and the tone has shifted. Job openings have fallen sharply. Hiring cycles have stretched out. Employers are more cautious and selective. Workers who try to switch jobs are finding fewer options and less generous offers. Economists sometimes call this a hiring recession. Not a firing recession, a hiring one. In a firing recession, you see massive layoffs and dramatic headlines. In a hiring recession, companies simply stop growing. They quietly pull back on new roles, delay backfills, and keep teams lean. And that kind of slowdown can be just as important, because it tells you where businesses think the economy is going. Another key piece of the puzzle is the labor force participation rate, the share of people who are either working or actively looking for work. Recently, it's been ticking up, which normally sounds like good news. More people entering the workforce can mean more confidence and more opportunity. But when participation rises at the same time unemployment rises, it suggests something else. People are coming back into the job market, and not finding work quickly. That's the kind of subtle shift that often shows up before the bigger cracks appear. It's quiet, it's gradual, but it's meaningful. So when we say unemployment is at 4.6%, that number carries a story. A story of a labor market moving from exceptionally tight to noticeably cooler, and that transition matters for what comes next. Household impact, the real-world effects. Let's move from the macro to the micro, from the headline numbers to the kitchen table. Because unemployment isn't just an economic indicator, it's a lived experience. Wages versus inflation. On the surface, wages are up. In many industries, paychecks are larger than they were a few years ago. But the critical question is, are wages growing faster than prices? For many households, the answer is no. The cost of essentials, groceries, rent, insurance, utilities, healthcare, energy, has climbed significantly. When you adjust wages for inflation, the real purchasing power of many workers has barely moved, or even gone backwards. So even in households where everyone is employed, there is a sense of being squeezed. The margin for error is thinner. One unexpected bill, one car repair, one medical surprise, and the budget is blown. Job security anxiety. When unemployment creeps higher, even by a percentage point or two, people feel it emotionally. Conversations at home start to shift. Let's hold off on that new car. Maybe we should wait before we book that vacation. Let's build up the emergency fund a bit more. Workers who might have considered changing jobs a year ago now think twice. They worry about being last in, first out, if they move. They worry about joining a company that might downsize 6 months later. This caution leads to less job mobility, less risk-taking, and less spending, and that, in turn, can slow the economy further. It's a feedback loop driven by emotion as much as by math. Then there's debt. Credit card balances are high. Auto loans have become more expensive as interest rates rose. For many, student loan payments have kicked back in after a period of relief. When unemployment rises, even modestly, these obligations become much harder to manage for those who are directly impacted, and even for those who fear they might be next. Late payments start to increase. Delinquencies rise. Households that were barely staying afloat begin to fall behind. That financial strain isn't just a line item. It's a source of stress, of anxiety, of tension inside families. Unemployment also doesn't hit all age groups equally. Younger workers, especially recent graduates, often face the toughest environment when the job market cools. There are fewer entry-level roles, more competition, and less flexibility for employers to take a chance on someone without a long resume. Meanwhile, older workers who lose their jobs often struggle to re-enter at similar levels of pay or responsibility. Age bias, skill mismatches, and higher salary expectations can make the search longer and more discouraging. So when we talk about unemployment at 4.6% or higher, we're really talking about a series of very human stories. The graduate sending out dozens of resumes with no reply, the mid-career worker worried about layoffs, the family trying to stretch each paycheck just a bit farther. The economy shows up in people's lives long before it shows up in quarterly reports. Policy dilemma. The Fed's tightrope walk. Now let's shift to the policy side, especially the role of the Federal Reserve. The Fed has a dual mandate: maximum employment and stable prices. Right now, those two goals are in tension. The Fed's challenge. On one hand, we have a labor market that is clearly cooling. Unemployment is up from its lows. Job openings are down. Wage pressures are easing. On the other hand, inflation has been stubborn. Even as some categories cool, others remain elevated. Tariffs, energy prices, supply chain shifts, and structural changes in the global economy are all contributing to a backdrop where inflation doesn't fall as quickly as policymakers might like. If the Fed cuts interest rates too aggressively to support the labor market, it risks reigniting inflation. If it keeps rates too high for too long, it risks pushing unemployment significantly higher. That's the tightrope. Beyond the economics, there's political pressure. As unemployment rises, you hear more from businesses, from households, and from elected officials. There are calls for relief, for stimulus, for intervention. Congress may begin debating fiscal measures, targeted aid, tax changes, support for specific industries, and all of that interacts with what the Fed is trying to do. The Fed, in theory, is independent, but it operates in a very loud environment. Financial markets hang on every word the Fed says. A single sentence in a press conference or a change in tone in an official statement can move bond yields, stock indexes, and currency markets around the world. When unemployment edges higher, that communication job becomes much harder. The Fed has to acknowledge the reality of a cooling labor market without triggering panic or giving the impression that it's losing control of inflation. And all of this is happening in a global context. Europe is dealing with its own set of challenges. China is facing structural growth issues and, in some areas, deflationary pressures. Other parts of the world are wrestling with debt, currency volatility, and geopolitical risk. The Fed doesn't make decisions in a vacuum. US policy affects the rest of the world, and global conditions feed back into the United States. So when we look at unemployment at 4.6%, we have to see it as part of a larger balancing act: growth versus inflation, domestic needs versus global realities, short-term pain versus long-term stability. It's a tightrope, and there's not a lot of margin for error. Scenario analysis: what happens if unemployment keeps rising? Now let's take our deepest dive into the scenarios. Unemployment at 4.6% is not the end of the story. It's the starting point for a path. And where that path goes matters for households, businesses, and policymakers. To make sense of it, let's imagine three possible levels. Unemployment rises to 5%, unemployment rises to 6%, unemployment rises above 7%. Each level is more than a number. It represents a shift in psychology, in behavior, in risk, and in policy response. Let's walk through them, one by one. Scenario 1, unemployment at 5%, the yellow flag zone, at 5%, we're not in crisis, but we're in yellow flag territory. This is the point where the economy starts to feel weaker, even if the headlines haven't turned dramatic yet. At 5%, households begin to change how they act. Big purchases, like cars, major appliances, vacations, get pushed out. Families prioritize building or rebuilding an emergency fund. Job switching slows down as workers cling more tightly to stability. Younger workers find it just a bit harder to land that first job or that ideal role. This shift in behavior alone reduces demand in the economy. Less discretionary spending means less revenue for businesses that rely on it. On the business side, the tone changes from cautious optimism to defensive planning. Hiring freezes become more common. Open roles go unfilled for longer. Temporary and contract workers may see hours cut. Expansion plans, new stores, new locations, new product lines, are delayed or scaled back. This is what you might call a quiet tightening. Companies don't always announce it loudly, but inside boardrooms and budget meetings, the message is clear. Let's be careful. Financial markets at 5% don't panic, but they do start to reposition. Investors may rotate from aggressive growth stocks into more defensive sectors like utilities, healthcare, and consumer staples. Bond markets begin to price in the possibility of more rate cuts down the road. Analysts trim earnings forecasts slightly, especially for sectors tied closely to discretionary spending. For the Federal Reserve and policymakers, 5% unemployment is a warning light, not yet a siren. The Fed might not move aggressively, but it will start messaging more openness to easing if the labor market continues to soften. It will talk more about downside risks to growth and monitoring the data closely. That's the yellow flag scenario. The economy is still functioning, but the direction of travel is concerning. Scenario 2, unemployment at 6%, the orange flag zone. At 6%, the strain becomes harder to ignore. This is the orange flag zone. The slowdown is no longer subtle. It shows up in everyday life. Household stress intensifies. At 6%, you typically see more households falling behind on credit card payments. Auto loan delinquencies rising. Renters struggling to make monthly payments on time. Student loan burdens feeling heavier as job security weakens. For families who are already living close to the edge, even one lost paycheck can be the difference between stability and crisis. Underemployment rises. The headline unemployment rate doesn't capture everyone who's struggling. At 6%, underemployment becomes a bigger story. People who want full-time work can only find part-time roles. Skilled workers accept lower-paying or lower-skilled jobs just to stay employed. More people turn to gig work or side hustles out of necessity, not opportunity. This creates a layer of hidden economic fragility. People may technically be employed, but far from secure. Regional inequality widens. The pain is not evenly distributed. Regions reliant on manufacturing may see sharper job losses. Areas tied to export industries feel the effects of weaker global demand. Rural communities often experience slower job creation and fewer alternatives when layoffs happen. Urban centers with strong tech or healthcare hubs may hold up better, but even there, hiring cools. This uneven impact can feed resentment and political tension, especially if some communities feel left behind while others appear insulated. Corporate strategy shifts. At 6%, many companies move from hiring freezes to targeted layoffs. Middle management layers may be trimmed. Projects classified as nice to have, rather than essential, are cancelled. Departments tied to growth, marketing, recruiting, long-term R&D, shrink first. Efforts to automate, streamline, and cut costs intensify. The focus becomes protecting margins and preserving cash. Markets and policy. Financial markets begin to treat the slowdown as real. Earnings forecasts fall more sharply. Market volatility rises. Investors increasingly expect a series of rate cuts, not just one. In Washington, conversations about fiscal support become louder. Proposals emerge for targeted aid, sector support, or broader stimulus. At 6%, the economy is under real, visible strain. We're no longer just watching indicators drift, we're seeing clear signs of stress in households, businesses, and markets. Scenario 3, unemployment above 7%, the red flag zone. Now we come to the scenario no one wants, but everyone should understand, unemployment above 7%. This is the red flag zone. This is where the economy stops merely cooling and starts contracting. At this level, the labor market isn't just a warning sign. It becomes the epicenter of the downturn. Let's walk through what that looks like, layer by layer. 1. Labor market breakdown, from hiring freeze to layoff wave. At 7% and beyond, we move from scattered layoffs to broad layoff waves. Retail chains begin closing underperforming stores, not just trimming staff. Manufacturing plants reduce shifts, shut down lines, or temporarily close facilities. Construction projects are halted midway because financing falls through or demand evaporates. Tech companies, which might have already trimmed earlier, go through deeper restructuring. Logistics and transportation slow sharply as fewer goods move through the system. This is where many workers experience not just the fear of potential layoffs, but the reality of job loss. And there's a multiplier effect. Every job lost leads to secondary impacts. A laid-off worker cuts back spending immediately. Local businesses see lower sales. Those businesses then cut hours or staff in response. That leads to more job losses and further spending cuts. It becomes a self-reinforcing cycle of contraction. 2. Consumer confidence collapses. The psychological recession. Economies don't run on numbers alone, they run on confidence. At unemployment above 7%, confidence doesn't just weaken, it collapses. Households move decisively into survival mode. Discretionary spending, dining out, entertainment, travel, non-essential shopping, drops sharply. Big-ticket purchases are postponed indefinitely. People focus on paying down debt when they can and building up cash buffers. Financial anxiety becomes a daily reality. Even those who still have jobs are affected. They witness layoffs around them. They hear about hiring freezes. They watch the news. So they become more cautious. They avoid career moves that feel risky. They delay major financial commitments. They mentally prepare for possible income loss. This creates what you might call a psychological recession, a downturn in behavior and sentiment that can be as powerful as the official data. 3. Debt stress turns into a debt crisis. At this point, debt, which was already a concern at lower unemployment levels, can become a central economic threat. For households, credit card delinquencies rise significantly as people use plastic to bridge income gaps. Auto loan defaults climb. Some families simply can't keep up with payments. Renters fall behind in larger numbers, forcing difficult decisions for landlords and tenants. Mortgage delinquencies, especially among recent buyers who stretch to afford high prices, begin to tick up. For small businesses, revenue slows or drops. Access to credit tightens as banks grow cautious. Refinancing existing loans becomes more difficult and more expensive. Some businesses are forced to close, not because they lack customers forever, but because they run out of time and cash. Banks and lenders respond defensively. They raise lending standards and tighten underwriting. They reduce credit limits and become cautious with new approvals. They adjust pricing to reflect higher risk. That tightening, while rational from their perspective, amplifies the downturn. The very moment when households and businesses most need flexibility, it becomes harder to get. 4. Corporate earnings fall sharply. The profit recession. With demand falling and costs still elevated in many areas, corporate earnings come under serious pressure. Revenue declines. Retailers see weaker sales across categories. Restaurants and entertainment venues see fewer customers. Travel and hospitality bookings drop. Manufacturers receive fewer orders, both domestically and from abroad. Margins get squeezed. Some costs, like rent, long-term contracts, or debt service, don't fall just because sales do. Companies may face higher costs for materials or logistics, even as they sell less. To attract or retain critical talent, they may still need to pay competitive wages in key roles. Under that pressure, corporate leaders cut guidance and lower expectations for future quarters. Freeze or reduce capital expenditures. Slow or suspend share buyback programs. In some cases, reduce or pause dividends. What begins as a labor market story turns into an earnings recession, a broad profit squeeze across corporate America. 5. Stock market reaction, volatility and flight to safety. Financial markets are forward-looking, and unemployment above 7% is a loud signal. Investors typically react in a few ways. There's a flight to safety, more money flows into government bonds, utilities, consumer staples, and sometimes gold or cash equivalents. Growth stocks, particularly in cyclical industries, often sell off more sharply. The VIX, often called the fear index, tends to rise as volatility increases. Market indices can move into a prolonged correction or even a bear market if confidence in earnings and growth is heavily damaged. For long-term investors, these periods can eventually present opportunities. But in the moment, the emotional tone is dominated by uncertainty and fear. And again, this feeds back into the real economy. When portfolios fall in value, when retirement accounts shrink, when volatility dominates headlines, people feel poorer, and they behave more cautiously. 6. Government intervention becomes inevitable. At unemployment levels above 7%, policy response is no longer optional, it's expected. From the Federal Reserve, interest rates are often cut more aggressively, unless inflation is still dangerously high. Liquidity programs may be expanded to ensure that credit markets keep functioning. Communication focuses on reassurance, the idea that the Fed will do what it can to support the economy and restore stability. From Congress and the administration, you may see proposals for direct payments, enhanced unemployment benefits, or tax relief. Aid may be targeted to specific industries, for example, travel, small businesses, or housing. Infrastructure or investment programs may be used to support jobs and stimulate demand. At the state and local level, governments feel the squeeze of falling tax revenue. They may cut back on services, delay projects, or seek federal assistance. Public sector employment itself can come under pressure if budgets are strained. The interplay of monetary policy, fiscal policy, and local government response becomes central to how long and how deep the downturn goes. 7. Global spillover. When America slows, the world slows. The US economy is deeply embedded in the global system. A US labor market downturn at this scale has international consequences. Global trade contracts as US consumers and businesses import less. Export-driven economies feel the slowdown directly. Emerging markets that depend on US investment, tourism, or dollar-denominated financing face increased pressure. Commodity prices, for oil, metals, agricultural products, often fall as global demand weakens. Currency volatility increases as investors move into and out of the US dollar, seeking safety or opportunity. In short, a US unemployment shock is not just a domestic story. It's a global event. 8. Social and political impact. Finally, high unemployment doesn't just impact balance sheets. It impacts society. When large numbers of people are out of work, or fear losing their jobs, stress, anxiety, and mental health challenges increase. Families may rely more heavily on social services or community support. Homelessness and housing insecurity can rise in vulnerable regions. Long-term unemployed workers may feel disconnected and discouraged. Politically, economic pain often fuels populist movements on different ends of the spectrum. Distrust in institutions and leadership. Demands for rapid, sometimes drastic policy change. In other words, The labor market is not just an economic arena, it's a social and political one too. When unemployment rises above 7%, those tensions can come to the surface in powerful ways. Closing insight for segment 5. So, when we think about unemployment going from 4.6% to 5%, then 6%, and potentially above 7%, we're not just imagining a series of numbers. We're tracing a progression. At 5%, the economy whispers. Households and businesses start to pull back quietly. At 6%, it speaks. Stress becomes visible, and the slowdown is obvious. Above 7%, it shouts. We move into contraction, and the labor market becomes the center of a broader economic and social storm. Understanding these scenarios doesn't mean we're predicting them, it means we're prepared to recognize them if they begin to unfold. So here's the bottom line. Unemployment at 4.6% is still manageable on its face, but the direction matters more than the level. The labor market is cooling. Households are feeling the squeeze from inflation and debt. Businesses are shifting from expansion to caution, and policymakers are walking a tightrope between supporting growth and controlling prices. We'll continue tracking this story every day, watching the data, the policy moves, and the human impact, right here on the Daily Economy 24/7. If you found this breakdown helpful, consider subscribing, sharing this episode with someone who follows the markets, and leaving a review so others can find the show. Stay informed, stay aware, and as always, stay ahead.